Good evening. This is Dave Stech, and I want to welcome everyone to the 2020-21 State of the Union for Realtors and Real Estate Investors and what's coming next. It is July 15th. This is Dave Stech. Most of you, if not all of you, already know me, but I'm sure we're going to have some newbies who've only heard of me. So I'm telling you first that I'm really excited about what we're going to talk about tonight. And you're going to understand why I'm excited by the time we get to the end. So first, a disclaimer, and that is to let everyone know that myself and my team are individuals and entities that are acting as individuals and not representatives of our respective companies. We're not attorneys. We're not accountants. We don't play them on TV. We're not offering any kind of investment advice in this webinar. We're simply trying to help educate you. We're not trying to solicit or offer any securities. We won't be doing so. Our goal is really simple, to educate you so all of us are better informed investors, and hopefully we work together. And if not, that's fine too. But at the end of the day, you're responsible for making your own decisions, and we urge you to seek professional advice when considering any options that affect your future, your family, your money, and your health in this day and age. So welcome to Lockdown in Paradise. For those of you who've not been on a webinar with me in the past, that is a new photo for you. But that is the picture from my balcony here in the Caribbean. So some of you have been in and are out of, or maybe back in, quarantine like me. Some of you might be back to living life sort of normally outside your home. And in either case, welcome to my home in Puerto Rico, the home of a Puerto Rican. You see, I've moved here 6 years ago, and I sort of joked that when I moved here, I was a Puerto Rican, and now I'm a full-fledged Puerto Rican, even though I still don't have the skin color for it. People are always asking me, what's your favorite thing about living in Puerto Rico for 6 years? Well, there's not just one thing. There's actually two things and a lot of other ones, but my top two are that I pay zero corporate tax and 4%, I rephrase that, 4% corporate tax and 0% capital gains, interest income, and dividend income. I don't pay the same tax that you pay in the U.S., although I do have U.S. income that is taxed at the rates that you're accustomed to. But for all my Puerto Rican sourced income, which is the majority of what I have, it's taxed at a very low rate. What isn't taxed at a lower rate, or rather taxed at a lower rate, is actually my self-directed Roth IRA. So between my Roth IRA, between Puerto Rico, and between day sailing on a private catamaran to a private island occasionally with insider friends of ours, talking about winning the money game, life could not be better. You see, the money game never changes. It's just the strategies that change depending upon where we are in the market cycle. But we're always looking to generate more cash, otherwise known as income, accumulate more wealth by having more assets that both go up in value and generate more cash, and then doing our darndest to try to keep as much of both as we can. Well, at the end of the day, I've got two of my insider friends who are responsible for you and I being on this call tonight, and that's Rob and Jen Flick. They live 3 blocks away from my wife and I here in Puerto Rico. And I want to always start by thanking Rob for asking me to first keynote at the 2020 Freedom Summit in Mexico, which was in February, right before COVID, where I met many of you that are on the webinar tonight. And then 2 months ago, I met some of you on the Built for This live event. A month ago, I was asked by Rob to give another update, which was on May 28th. And here we are now 6 or 7 weeks later, and I'm sharing a brand new State of the Union for Realtors and Real Estate Investors, and really to address the question, what's next? And oh, by the way, what am I doing about it? So I want to thank Rob and Jen. Were it not for them, I wouldn't be doing this tonight. And I'm grateful for their friendship. My wife and I are in the lower left corner. Rob and Jen are in the right. And that's the group of us standing on his balcony having a bottle of Dom not long ago. Well, that leaves the best for last. That literally leaves you. Now, I don't know how many officially registered, but I know that it was capped at 500. So I took a screenshot at 418, and I wanted to thank all 400 plus of you tonight. You see, I know we're all in the middle of an extended uncertainty, and I also know that you've taken time tonight to listen to my thoughts on how to be the victor, not the victim, during these unprecedented times. Now, this isn't the first time I've done this. I've been doing this State of the Union for real estate investors annually for 15 years. What's ironic is that this year, I've done it more in the first half of this year and updated it more frequently than I have in the previous 14 years. It has been a chaotic year. And so tonight, you're going to see information that you haven't seen before, even for those of you who've attended this before, even for those of you who are insiders as part of the group that we have built that launched on January 1st. You're still going to see information that's new tonight, and I hope you enjoy it. In 2019, I forecasted a recession in 2020. There were a lot of different things that could have triggered the recession, and all those bubbles represent a number of them. What I hadn't anticipated at that time was that oil prices would collapse or that COVID would enter the scene. It's been a crazy year. And even though I forecasted right, what really triggered this whole thing is different than that which I expected. So when Rob asked me to present again tonight, I'm always asking myself the same questions. If the roles were reversed and I were you, what are the key things that I'd want to know about where are we now and what's coming next? And more importantly, what am I doing about it that you could do too? You could cheat off me. So most of you know I'm a market timer. You know, a lot of people refer to me as a real estate investor or a private lender or a fund manager. But at its core, I'm a market timer. I want to figure out when. If I can get the when right, everything else will work itself out. And we'll talk more about that in a second. But who could have ever imagined investing during a year like this? This first 6.5 months has been nuts. The world closed for business. It tried to reopen. It looks to be closing again at some level, all due to COVID-19. The U.S. literally turned into ghost towns. Imagine Las Vegas on a Saturday looking like that, or New York City looking like that on a weekend. Imagine Washington, D.C. during the week looking like that. Imagine Chinatown on a Saturday morning in San Francisco looking like that. And imagine a weekend in California on the beach looking like that. Well, what does our research tell us now? Because things have changed from those photos that I just showed you. And what it's really telling us is keep a close eye on what I call the big three. You see, in real estate, there are really three key things that we should all be tracking. Number one is sales price. Is it going up? Is it going down? Is it going sideways? Interest rate, same directions. And number three, income. Again, same directions. Things can go up, they can go down, or they can go sideways. Those three things together make up the affordability index. And affordability, the ability to afford something, either drives demand or it doesn't. Sure, there are other indicators, and we're going to cover them tonight. But let's take a quick look at these three first because they are so significant and so important. Sales price. Well, if you look at the line in red, where I've got the red arrow pointing to it, and you go back to June 2019, a year ago, you can see that we're pretty much where we were a year ago. You see, sales price is pretty much topped out at a little bit, over or under $300,000. At the end of the day, that's where we've been for roughly a year. And COVID, as you can see, has impacted it slightly, but not significantly. Interest rates. Well, that's a change. Look where we were over the course of the years. In fact, go back to the early 90s and you can see we had an interest rate in excess of 10%. And some of us remember earlier than that, back to the days when interest rates were 12, 16, 18%. crazy times. Look where we are now. Who could have ever imagined interest rates between 2.5% and 3%? Crazy. Then there's income. So if sales price hasn't changed much and interest rate has come down, which has helped affordability, what's happening with income? Well, I'll tell you, unemployment is a serious, serious issue. You can see that the U.S. rate of unemployment was 13.3% as of the end of last month. And remember, it was at 3.5% before COVID came on the scene. If you're in Michigan, you are in second place at 23.8%. If you're in Nevada, you're in first place at 29.8%. Uncertainty is returning because these interest rates were prior to the recent shelter in place that we appear to be moving back to in a number of states. Why is that happening? Case numbers and now deaths are both trending up. If you look at the arrows at the top, you're going to see on July 13th, which was what, Sunday? Or was it Monday? Monday, July 13th, you could see that there were 61,000 new cases and 400 new deaths. And the 14-day change was 51% in cases and 29% in deaths. One day later, cases have jumped to 66,000 and deaths have more than doubled. So what we're seeing down here, and you may recall this on the last State of the Union address that I did, on May 28th, there was a leveling and actually a decline in terms of the number of cases and a steep decline in terms of the number of deaths. Look how significantly it's gone in the other direction. And now deaths are following. So we're seeing a significant increase, and therefore a number of states have paused or reversed their reopenings. So imagine what the impact on gross domestic product and our overall economy is. You see, the Fed can only do so much. Our government can only do so much. And they're throwing everything they possibly can to be able to ensure that we don't go from a recession to a depression. And yet lost income is skewed to the lower earners. That probably doesn't surprise many of you, but there are 2 points worth making here. Number one, the higher your income, the less likely you are to have lost income. And number two, the broader your passive recurring residual income, the less impact there is if your active income is impacted. The point I'm making is that you should always strive to be a higher income, higher net worth individual. Duh. But you've got to make sure that it's not just active income that you're generating. You've got to make a move seriously to passive recurring residual income. Our family has that. We have a backpack business where we can operate our companies all around the world. I always joke that you can always find me at one of my 31,000 offices around the world called Starbucks. And the truth is, I'm not even there now. I'm in lockdown here in paradise. But lost income hasn't peaked either. You see, it's still going up, and 36% of households expect to lose more income over the next 4 weeks. The group that's actually in the best shape are the seniors down there at the bottom who are on fixed incomes, so things are better for them than they are for a number of other folks. Yes, affordability is up due to record low mortgage rates. We talked about that. But home price ratios are really a cause for pause. You see, if we look at the affordability indicators, we see that they're in pretty good shape. They're generally average to strong to excellent. You can see that the home equity indicators are also strong, and we'll talk about that in a second. But home price ratios, the ratio in terms of the index versus intrinsic home value and the price to income ratios are poor. So at the end of the day, we're living on a bit of borrowed time. The good news is when foreclosures start occurring, which they will going into next year because the government stimulus can't continue forever. The good news is home equity numbers as we entered 2020 were astounding. And I mean astounding in a good way. You see, if home prices fell 10%, roughly 6 million homeowners out of 128 million would be underwater, and the rest would still have equity. So we're not going to go through a situation like we went through in 2007 through 2009. Now let's talk briefly about an economic update. I'll start with consumer spending. While it's still down, it has been rebounding, and it rebounded through the end of June. Well, guess what? This first couple of weeks of July are going to tell a bit different story because, of course, a lot of businesses are shutting down again. But who's cut their spending the most as a result of this drop in consumer spending? Is it the low-income consumers? Well, they actually cut theirs 30%. They cut their spending about 30% at the trough, in other words, at the worst point in COVID. And they're currently spending at a level higher so that they're only down about 4%. How about medium income consumers? Well, median income consumers are at 32% at the trough and currently at 10%. And those of us who are high income consumers are down 36% at the trough, and we're still down 17%. In other words, those of us with the most purchasing power, which the economy is banking on, we feel it prudent to cut back during times of crisis, not to spend. And we can afford to do so. So that translates into more investment power. You and I not only have more purchasing power, but we've got more investment power. Spending, remember we were just talking about consumer behavior earlier when we talked about on the previous charts. Now let's talk about spending indicators as a measure of economic growth. Well, you can see that they're generally weak to poor, which is pretty much a summary of what we just talked about. Demand indicators as a measure of economic growth are a mixed bag. You can see they're pretty well spread all over. So demand is a mixed bag. And what we're calling efficiency and malaise, malaise is discontent or being uneasy about something. Efficiency, malaise, and inflation indicators as a measure of economic growth are mixed too. You can see at the bottom that inflation is viewed as excellent or strong because it's not going up. In other words, there's not an increase in inflation. It's staying pretty constant. But that could change, and it likely will. And we'll talk about that as we get into this. But as you can see, in terms of efficiency and malaise, things are not good. Yields on inflation-linked treasuries, which are referred to as TIPS, continue to fall. They've been moving deeper into negative territory, and the lower these go, the lower interest rates go. So that's good news for those of us who want lower interest rates. But remember, there are some areas of the world, like Japan and Europe, where they have negative savings rates. So literally, if you want to save money in a bank in Europe or in Japan, you may have to pay to have your money on deposit between 0.5% and 1% per year, just for the privilege of having your money in a bank. We haven't gotten there yet, but it could happen. Now, TIPS and the bond market expected inflation rate can actually lead to higher inflation expectations, which can lead to higher mortgage rates. The good news is right now we're at 3.24%. And U.S. corporate debt is approaching 50% of gross domestic product, which marks a record high. Now, this ratio is likely to climb further in the second quarter, and this is not a good thing. It's quite amazing, actually, because the number of what we call zombie firms has been appalling. It's actually tripled since 2008. 18% of public companies can't even service their debt. Basically, on the consumer level, that means 18% of you on this call, if you were corporations, could not afford to pay all your debt. So at some point, they're either going to have to refinance or they're going to have to file bankruptcy or both. COVID has had a negative effect on small businesses, not just publicly held businesses, and 82% have sought some form of public assistance, or I should say financial assistance, most notably the Payment Protection Program, the EIDL program, the stimulus that was offered to individuals, mortgage forbearance, all kinds of things that we can get into. And what's important is that as real estate investors, you understand that we've already begun deflation. We're already very familiar with this because our housing industry is cyclical. It means that during every housing cycle, we experience yet another cycle within a cycle known as the deflational spiral. So what happens is, or deflationary spiral, what happens is there's falling demand, that converts to business losses, that creates falling prices and then layoffs and debt defaults, more bankruptcies, falling tax revenue, which increases real debt burden, and then the spiral continues. We're already there. And typically industries experience this deflationary cycle at different times, but not with this downturn. It's happening to nearly every sector at the same time. And then once deflation happens and once things bottom out, there's the risk of inflation. Now, a simple example for those of you who don't understand inflation and deflation, and without my going into a graduate level course on economics, just imagine, for example, if we take some metrics on single-family residential. If we look year over year through March, that is March of 2019 compared to March of 2020, inflation had driven prices up about 3.4%. But deflation, in other words, operating cost efficiencies, had reduced costs to the point where deflation had a real impact of 3.8%. So there's a spread, which is good for those of us as tenants. If you experienced this is an average, but if you experienced it, you saw a 7% improvement in your margins. In the last 50 years, there's only been one period of deflation. Guess when that was? 2008, 2009, 2010, when we were going through the Great Recession. And we saw at that time personal consumption expenditures go negative year over year. Well, get ready for another one. We're already there. Housing market. That's very interesting to most of you, and you're going to be hearing that housing is the one bright spot in the economy. If you look at the purple box, which is 1 year ago, and you look at the check marks, which are now, you'll see that economic growth is weaker than it was last year. That shouldn't surprise anyone, which includes leading economic indicators and consumer behavior. We've just been through that discussion. We also know that affordability is slightly better because interest rates are lower. We also know that housing supply is better. Now, what does that mean? Better. It actually means that there's lower inventory, which is a positive in terms of housing supply because it buoys price. The new home market is roughly where it was a year ago, and the existing home market is roughly where it was. So housing is one of the bright spots in the economy, and general industry demand in real estate is stable or increasing. If you look at the last 3 months, the last 11 or 12 weeks, you can see that in blue, it's been increasing at a significant rate, and in red, it's been decreasing at a significantly reduced rate. So that's good news for real estate. Supply is only rising in one of 33 markets. And this is that notion I referred to before where inventory is low and getting lower. At least right now, supply is declining in 32 of the 33 top markets. So housing supply indicators are strong. In other words, low supply. Low supply in single family, generally in multifamily, although it's been weakening, and in terms of the total starts and permits and housing stock and so on, things are pretty good. So supply is something that we came into this year in good shape on, and it's only gotten lower. So that's good for price. It keeps price healthy. There was a drop in May and June existing home sales that affected every region within the U.S. There was no region that didn't. And inventories, just like we talked about in terms of month supplies, but inventories, as you can see in blue for 2020, are up. But look at previous years. If you look at the previous 7 years, you see that the seasonal generally drives inventory up from January to February to March, and then it starts going down again in April and May because we get into the spring and summer seasonal. Right now, inventory took a blip up in May, but when we get June actuals, we'll see that it's come down. Month supply is trending up more in the high price tier. That shouldn't surprise any of you on this call who've heard me speak about this before. Generally, luxury homes and sort of the top 20% tier of prices generally get impacted first. And often the bottom 20% get impacted, but not in single family, generally in condos. One bedroom, one bath condos generally get adversely impacted in price when the market starts to soften. Why? Because people didn't want them generally in the first place. They bought them because they were more affordable because prices were going up. If we look at market demand, we can see that it's average to strong. Existing home market in terms of appreciation is sort of average or below average, actually. And in terms of sales volume, it's pretty good. Pending sales vary significantly by markets. In some markets, the rolling 4-week total of pending sales is up 35%. And in Salt Lake, it's down 67%. So it's all over the board in terms of pending sales. But list prices are up in all major markets, again, driven by low interest rates, the demand, and low inventory supply. So list prices have been held up in most major or in all major markets. Searches for existing homes are up 18% year over year. Google searches for existing homes are up in all major markets, not just across the board, but in all major markets. Days on market is increasing, however, in urban areas. And you're going to see that continue. You're going to see a flight out of the cities into more suburban and second city markets. Google searches for new homes continue to be positive. Of course, during this sort of 6-week period from the middle of March to the end of April, we saw a real drop in terms of Google searches, which is a measure of the future. It's called predictive analytics. And what we're seeing now is that there's a positive future for new homes. And Google searches are up in all major markets, and in some markets, really up. Median price we talked about before. Now we're looking at median price here over a 30-year period. But as you can see over the last couple of years, which is what we talked about at the beginning, it's been flat. Sales are varying by purchaser demographic. Entry-level and first move-up sales are normalizing. Second move-up and luxury are actually improving now because of low interest rates and some motivation around sales because of movement and so on and so forth. But 55 and active adults are lagging. They're generally in homes that they want to stay in, and so there's not going to be much movement there. COVID was actually the driving factor in 69% of recent home purchases. And what that means is that something related to COVID, whether it was a desire to get out of an apartment because you were too close to your neighbor or you were worrying about recirculating air and went to a entry-level single-family home. Maybe it meant that mortgage rates allowed you to move into a nicer home. Maybe you didn't like the layout of your current home or you wanted a larger home. The point is that COVID is being given credit for a fair amount of the activity today, and more people are increasing productivity as they work from home. Isn't that interesting? We've all felt like maybe we needed to supervise our people, or maybe our bosses thought that they needed to supervise us. Well, 75% of Americans currently working from home said that they would prefer to continue doing so for at least half the time. You know, they're not missing the, quote, community as much as you might think they are. Also, 66% would consider moving if their employer gave them the flexibility, and 24% said social distancing might drive a desire to move. So we're going to see more of this. Further, domestic migration, there's a huge shift underway. People are leaving the major metro areas for these smaller metros, primarily in the South and the Southeast, but also in California. So where are they leaving from? Generally from California. And when California loses migration, it generally migrates to one of 9 states. And we don't have time to get into it now, but when you know that, you can anticipate this as we have and move into those states, either from a real estate investing standpoint or from a lending standpoint, which we do a lot of, to flippers. And you're seeing an exodus from the Northeast and the Midwest down to the South and the Southeast. Over 1/3 of current renters want to own in the next year, but 80% would reconsider if interest rates rose past 5%. So that appears to be the point at which most people believe that they would stop buying. Now, the truth is, if we start getting above 4%, there's going to be cause for pause, and I think all of you know that. The good news is purchase mortgage apps are back up to pre-COVID levels. You know how there's a discussion around, sort of the V-shaped recovery? Well, that happened in the purchase mortgage space. So if you're in the consumer mortgage space, we're back up to pre-COVID levels. Resale price forecasts. In case you're wondering, here's a glimpse or a peek under the tent at what we're anticipating. Obviously, resale price forecasts are going to be all over the board depending upon the market that you happen to be looking at. So you can glance at them there. But generally, what you'll see is we anticipate that over the next year or two or three, we're going to see roughly 2% or less home price appreciation. This year and going into next year, we'll likely see a decline and then a recovery after that. So we'll see a positive for most of this year, overall for this year, but getting negative in the balance of the year. And then we'll see more negative next year. Because when government stimulus wears off and moratoriums on evictions are lifted and forbearance on mortgages are lifted, you can see that something's got to give. So a quick summary. First, it's a good time to be selling homes or selling your home and actually living where you want. And what do I mean by that? Well, bottom line is just think about where you're living now and where you might want to live. Consider expanding or moving your business to smaller markets in these non-urban areas. This is the time to relocate, especially from what we're calling out migration. If you know people are moving out of your state or your MSA, your metropolitan statistical area, and if you've been threatening to move for some time, this would be, let's say, your last best opportunity. For remodels or flips, if those of you who are doing this are investors, use floor plan designs to better accommodate work from home. That shouldn't surprise you. Strap in for a long economic recovery. COVID's going to cause even more economic damage, and it's likely to restrict growth for a very long time. Job recovery is going to take a minimum of 2 to 3 years for us to get back to 2019 unemployment levels, and I'm not sure we'll get back there. The long-term underlying fundamentals are less than positive, so exercise caution, fix your balance sheet, and work on improving your P&L. There are 3 things that you can do to improve your P&L, otherwise known as increasing your profit. Number 1 is increase your volume. Number 2 is increase the margin on something that you sell or do. And number 3 is reduce your expense. Those are the only 3 things you can do to increase profit, and I'd advise you to do all of them if you can. The fee recovery was driven by the Fed, the Treasury, but they created this artificial economy. The real economy is kind of in limbo until we find out how this artificial stimulus is going to play out and how well it's going to work. So we're not through this by any stretch, not just from a health, not just from a virus spread standpoint, not just from a death, but from an economic standpoint. So what am I doing? And what is my family doing? Because we have a family office. We operate our family like a business. We have a mission, vision, values, strategies, objectives, key results, priority initiatives. We literally run our family like a business. My 2 sons and I have become very successful, have created a very successful family office, and we do it by working together and optimizing all those things I talked about. The first thing that we're doing is research. A lot of research. We're doing more research than we ever have before. We're spending more money on research than we ever have before. And why? Because real estate leaves clues. The stock market can drop in a day by 10%. Oil can drop within a week by 20% or even more. Precious metals can drop, but real estate doesn't drop overnight. It leaves clues. When the market imploded in 2007, and it began in May of 2007, by February of 2009, 21 months later in California, prices had dropped 59%, but it took 21 months to do that. Well, at the end of the day, research uncovers clues, and it's all about the when and where. Housing takes roughly 3 times longer to reach a trough than the economy at large, so it leaves clues for those who know what to look for. What I said, again, is it's all about when and where. My example is Las Vegas. For those of you who are aware, in 2005, I spoke at Harvard and predicted that the market was going to implode. In 2008, I again spoke at Harvard and said that we were going all in Las Vegas, that it would be the number one buy market by 2010 or 2011 in America. And by 2011, I spoke again and said that the market was about to bottom, which it did in January of 2012. That is the most important thing I can figure out. It's the only thing you ought to be worried about, is when. If you can get the when right, everything else follows. But once you get the when right, the second most important thing out of the 5 things you need to know, the when, the where, the how, the what, and the with whom, once you get the when right, then figure out the where. And we predicted Las Vegas would be the number one market in the U.S. in terms of a buying market by 2010 or 11. And we predicted that in 2008. At that time, 68% of homes were underwater, and the market had fully imploded. It was the foreclosure capital of the world. Median price in mid-2002 was $147,000. It jumped to $140,000 per home. It doubled in price. And then it dropped $187,000 or 65% within a few years. And now here we are. Actually, in December of 2018, it's actually higher than this now. It rebounded by 160%. Now, how many markets do you know that go up $140,000, basically double in 4 or 5 years, drop 65% in 4 or 5 years, and come back up 160% in 4 or 5 years? It's the craziest thing. But if you can get the when to do this, which we did, and you get the where, which we did, you make a fortune. If you can invest in markets where the numbers make sense at this point in the market cycle, I'm talking about today, the next 12 months and the next 24 months. If you can figure that out, you're going to make a lot of money. There are only 4 markets out of the top metropolitan statistical areas right now that are growing. And those are markets that feature rising prices and volumes, as well as growth in investment capital. Then there are a lot of maturing markets that have peaking prices or volumes. They've got affordability that's going in the wrong direction because of price, or there's supply issues. And then there are declining markets. And many of you won't be surprised to see that a lot of these urban markets are really softening right now. Then there are also other markets, not just these 3 groups of markets. There are falling markets. And we're already seeing that in Chicago and New York City and actually in Orange County, for those of you in California. There aren't any at the bottom, and there aren't any in recovery. So we're at a point in our market cycle where we're at or near the top, and we're going through a pretty significant impact. So we've got to be very careful moving forward. We've got to invest in markets that are driven by in-migration. Remember how I talked about out-migration from California, the Midwest, and the Northeast to generally the South and to the Southeast? Well, there's in-migration occurring then in the South and the Southeast and a little bit in the Northwest, but that's slowing considerably. People are leaving the major metros for these small metros in the middle of the country. It's crazy, but areas like Iowa, for example, are seeing the benefit of people moving from California. And I was not on here in terms of one of the red dots, but there are some markets that are just weird markets. So our desired outcome is always to identify the 10 markets that will be hit the hardest. In this case, it's going to be because of COVID and the economic downturn that's occurred. And every market will either be heavily impacted, moderately impacted, or slightly impacted. And we're looking for all of those. because we do different things in different markets depending upon how impacted they are. And they're impacted by a lot of different sectors, from leisure and hospitality to retail, to education, to technology, to information, and so on. And at the end of the day, it's really important for us to look at the clues, to do the research. As I said, real estate leaves clues. And if you monitor this like we monitor it, it's like cheating, only legal, because you know what's coming next. And I always tell folks that knowledge plus experience plus research equals confidence. We don't worry because we know what's coming next. Now, that was number one, right? What we were talking about in terms of real estate and research. Number two is choose a market. Start with one. Before you get crazy and try to choose 10 markets that are going to be the hottest markets since sliced bread, here's an idea. Choose one. And in our case, we choose to target short-term residential. What do I mean by that? Well, we've compared all three real estate sectors, industrial, commercial, and residential. We've then evaluated within those three the 10 real estate subsectors. Factories and plants in the industrial area, that's not where we want to play for a lot of reasons that you could appreciate. And you know a lot of the deaths that are occurring right now as a result of COVID spreading in those areas. How about shopping malls? Now we're talking about commercial. Have you been to one lately? Planning on going soon? How about retail? Are you dining out as often as you were? How about office? WeWork, which was a darling a year or two ago, and it was expected to have a massive IPO, has completely fallen apart. And a lot of the technology companies and even others like Facebook and Twitter are announcing indefinite work from home. How about hotels? When's the last time you stayed in one? Are you planning on doing it anytime soon? Self-storage, not bad, but will people pay their mortgage payment or their storage payment first? Multifamily is overbuilt. Sorry to have to report that, but it is. It's the most impacted population segment, and there's preference for social distancing now from people who have a stigma associated with multifamily. How about Airbnb? What a darling. That was the darling IPO this year. Have you been to one lately? Yes, it is rebounding, but now what's happening is it's going to be softening as a result of all of the stay-at-home orders that are going to be happening, and now the shelter-in-place that's going to be happening in many states. So Airbnb has had to lay off 25% of their staff, and their IPO is now to be determined. And then there's single-family residential. We could spend hours talking about that, and many of you have heard me speak on these webinars for hours. So what you know to be true is what I'm about to tell you, even though I may not have put it this way before. We, our family, based on all of our research with all these sectors and all these subsectors, believe that single-family residential real estate is the subsector with the best risk-adjusted return over the next 3 to 5 years, so really 0 to 5 years, and within it, we prefer short-term. We prefer flipping and wholesaling and lending to flippers or wholesalers rather than buy and hold, because we believe there's going to be softness going into next year. So this is the time to do things short-term because it mitigates or even eliminates your risk in many places because you're in and out of a deal so quickly. Our mantra is get in, get out, profit, move on. Get in, get out, profit, move on. It's a very difficult business because it requires a lot of transactions over and over again. But if you're looking for safety, that's what we're doing. Number 3, private lend. You see, we're not just investing in flipping or wholesaling. We're actually lending to those that flip or wholesale. Our whole philosophy has always been, and we decided this when we went into Vegas, pick a market, own that market, and partner with others who own their markets. Think about what I'm saying. Pick a market, Las Vegas, for us in 2008 and 9. Own the market by flipping, by buying and holding, and by lending. And then pick other markets that we like almost as much as Vegas and partner with others who are doing what we are and teach them how to do it. That's how we crushed it this last decade. It's been unfair. It really has been great for our family. So we like private lending because the active investor, the flipper, has to find it and figure it and fund it and fix it and fill it and flip it. And all we really have to do is fund the deal. We like that. We also like the effort to return ratio. It's definitely the best of anything. And so we really enjoy the fact that as a private lender, we can check all the boxes in terms of our perfect wants in a business. In other words, the 12 things that we measure really highly on in terms of effort to return, especially compared to the flipper. So we created a workshop. Why? To help others, to help our insiders, as you'll hear about in a minute, how to be a private lender to flippers. It's called Just Be the Bank. It's now a virtual workshop that teaches all the necessary fundamentals to become a successful private lender on residential real estate and earn safe double-digit annualized returns. We've taught all 60 of our insiders how to be the bank. That's not true. Not all 60. I think we're up to 55 now. And after 4 workshops, the combined rating, not just from our insiders, but everyone who's gone through the workshop, is a 9.91 out of 10. So if you're interested in that, just go to justbethebank.com and just complete the form, and there's no obligation, and we're not going to chase you down, but at least we'll send you more information if you're interested. Number 4, pick the perfect partner whose research and strategies align with yours, and a partner that can actually execute. Now, on the left there, you'll see the co-founder and CEO who has a last name that looks like my last name, because it is. That's my youngest son, Josh, and you can see a little bit of his background. He was one of the 4 founding partners that built Lending Home into a billion-dollar company. He was also my co-founder and CFO at Purpose-Built Investments when we began, and you can see where he went to school and his degrees. And then his co-founder, Andrew, who was the former CFO of Airbnb, has an MBA from Harvard, very accomplished guy. And the two of them, about 18 months ago, co-founded a company called Sunday, which is the fastest growing real estate investment company in America. Why? Because they created the best flipping and lending team, and they've created the best technology in order to do it. So I bolded a few things. Imagine having 44 team members with 446 years of experience, 159 years of technology company experience, flipped 57,000 homes, originated 6,500 bridge loans and another 3,100 that they purchased, and all the other things. The bottom line is, if you're going to do something, especially if you're going to invest in a fund right now, make sure that you do it with people who've forgotten more than you're ever going to know about what they're doing. That's really important. And as it turns out, the financial markets agree. In fact, on June 30th, Housing Wire, I think, interviewed, along with Forbes, Josh, and talked to him about the fact that while other people are struggling to raise money, he raised $16.5 million from Peter Thiel, who's the founder of PayPal, and his Founders Fund, QED Investors, who are the founders of Capital One, a lot of other very, very successful people. So at the end of the day, when you've got that kind of corroboration, you can invest in stuff like Home Love 3, which is the third fund that they created specifically to take advantage of what's happening now and all the research that they've done and we've done as a family to make sure that we can optimize and earn double-digit returns, passive and recurring, with someone else doing all the work, where we write the check and get a bigger one back. Number 5, place strategic real estate technology bets. We've been doing this for 7 years, and here's one of them. This is actually our best one, but we've got a lot of other great ones, where we invested $10,000 and its current value is $1.46 million. A little company you may have never heard of called Hippo that does insurance in the real estate space by using probabilistic algorithms to be able to determine what it is that they ought to price their insurance at. So I'm not as familiar with it as my son is, but the bottom line is he has, through his sort of Stanford mafia connection, if you will, having built these unicorns, he's got access to these kinds of deals. State's Title. We invested $10,000 in that company at the very beginning, and they just raised $123 million Series C. So we've had, I think, a 40x multiple on that one. So we're placing strategic technology bets, starting in real estate, but in other areas as well, because real estate and software is eating the world. The top 5 companies in the world now are all technology-based companies. So we ask our insiders, look, we've been doing this anyway for the last 7 years. How interested are you in a technology venture fund based on what we told you about what we're doing and what we believe? Turned out that 94% said yes, less than 6% said no, and those that were no didn't have the liquidity at that time to be able to participate because they were fully deployed. So on the basis of that, we're launching in 4 weeks our Access Venture Fund. So we're very excited about that, and it's already fully subscribed, and now we're going through a discussion as to whether we ought to allow it to be oversubscribed for new Access insiders that come on board. Number 6, organize already successful people. This is massive. You've got to find people who have a passion for real estate like you do, that want to capitalize on this crisis like we do. That's what you want to find. But it's not about the masses of asses. It's about finding already successful people to do this with. So we created something called Access, and we concepted it last year. Not because we didn't have anything better to do, but we were looking at 2019, predicting a recession in 2020, and said, you know what, we can go this alone, kind of like we did in 2008 through 2010, and even into 2012 through 17, or we could literally take the opportunity to get the fewer betters, the already successful people together, and see if we can do something bigger together than we could ever do individually on our own. So that's what we did. On January 1st of 2020, we launched with one simple thesis. We want our insiders to believe, as we do, that we can all do more together than we could ever do alone. You've got to find people to do this with. If you don't, and if you can't find people who know more than you do about what you're doing, you're making a fundamental mistake. Because if you can organize, if you can strategize, and if you can execute and do it together with the strengths of all the people involved, you can accomplish what we did. Or you can play along with us. You can be a part of what we're doing. First, we had to organize. So in 2019, we anticipated a recession. I predicted it. And as a result, we started organizing, and we launched this on January 1st of 2020, 2.5 months before COVID happened. During that period of time where things have been in chaos, we've actually grown to 60 insiders in under 6 months. No organization does that. Then we got to strategize together for the last 6 months. We relentlessly did the research that you're seeing tonight. We vetted numerous opportunities, all those sectors and those subsectors. We collaborated with others who are equally smart in the real estate space and in the finance space. We worked through a process of de-risking everything, and we finally identified 2 strategies: a fix, or I should say a flip, a wholesale and private lending fund that would generate double-digit returns passively for our insiders, and a venture fund where we could potentially be in a longer opportunity where we could hit some home runs. And so we identified 2 strategies, and it was easy to mobilize insiders. I want you to listen to what I'm about to say now. Most people hear about a good deal. And what do they then do? They run around and find people. Maybe they find the money, and maybe they find an inspector to look at the property, and maybe they find someone that they're going to sell the property to. They do all these things after. Instead, we proactively did what we needed to do in 2019 to launch on January 1st, anticipating a recession, not realizing it would be tipped by COVID. And now we're ready to rock. And we've got 60 people to do it with. And as a result, we find that we're oversubscribed right at the get-go, and we're trying to figure out, how do we do it again, another fund, or do we just keep adding? Ultimately, what we have to do after we organize and strategize is execute. So we're able to invest together now, 60 of us, with more leverage and more purpose than we could ever do alone. And these two funds have both happened in the last month, because we were trying to figure this out just like you were trying to figure it out, or at least wondering what was going to come next, and we had to figure it out. Why? Because we're always in this to win the money game. But if we can win it together, it's fun. If you can make money, do good, and have fun with people you care about. If you can win the money game by generating more cash through private lending or through real estate investing from a cash flow standpoint, or from real estate investing from an appreciation standpoint, and private lending by building a little business and investing in technology or investing in funds that both generate cash and accumulate wealth. And if you can do it leveraging Roth self-directed IRAs, or move over here to Puerto Rico with me, at the end of the day, you get to win the game of money. And this is the same triangle that I drew for my sons 30 years ago on a napkin, trying to explain to them what the money game was all about. It hasn't changed at all. It never will. The only thing that ever changes are the strategies. And I'll tell you what, strategies are changing in a big way right now. For me, I prefer to live here, win the money game, and every single day generate passive recurring interest income, either directly by investing or lending on things I want, or indirectly by being invested in funds like the Home Love Fund or other funds like a venture fund, and basically generating interest income regardless of my active income, leveraging appreciation, which we anticipate next year, because appreciation comes in three forms. Instant, where you buy at less than its current market value. Forced, where you do something like a remodel to improve the value of a property. And market appreciation. We think next year is the year for instant appreciation, where we can buy more right than we've been able to the last 2 or 3 years. Optimize our effort to return by working together instead of working on our own, trying to do all this ourselves, and do it all from a backpack by creating a model that allows us to live anywhere in the world and make equal to or more money than living where we must live. So, what's that all about? Well, if what we're doing truly resonates with you, and if you're serious, just prove it. Take purposeful action. There's 2 things I want you to do. The first one is I want you to go to accessinsidergroup.com/EXP. And I'm going to send you an email within 30 minutes of this webinar so that you can do it yourself, and you'll have the link to click on to be able to do this. But that's the image that you're going to see of Rob and I. And this URL does say EXP, but some of you have been referred by other folks in EXP. And so this is open to all of you. We are not trying to limit the number of great people in the world to just folks that are in our direct universe. So you don't have to be part of EXP to submit your info, but you do have to be serious. So once you get to that page, scroll down, fill out some basic info, complete and click the button if you're serious, not just curious. And for those of you who already have done this, you don't have to do it again. But many of you haven't because you're new. And some of you haven't heard me speak before or present on a webinar. So if you haven't done this, do this. But for all of you, whether you've done this or not, I want you to also do number 2. Register for next Tuesday's Part 2 webinar. Next Tuesday, and you're going to get an email probably in the next 30 minutes with a registration link for that Access Insider webinar. So remember, it's next Tuesday, July 21st, same time as tonight, And there's 2 steps that I've asked you to do. Remember, I want you to do both if you haven't done the first one. So the first one is tell me about yourself by going to accessinsidergroup.com/EXP so I know more about you like you do me. And just hit submit. We're not going to chase you down. We're not going to do that sort of thing, but I want to learn more about who you are. I want to understand if you're both motivated and qualified. It's like any real estate. If a buyer is motivated, but they have no qualification, they either don't have the down money or they can't get financing, it doesn't matter. If they've got perfect credit and a boatload of money in the bank, but they don't want the house, nothing ever happens. I want you to be able to tell me that you're both motivated and qualified because we put together an amazing group that I'm going to tell you about next Tuesday. And if you're serious, not just curious, I'd like you to tell me about yourself. Again, if you've done it before, no need to do that. But all of you also need to do number 2. Be on the lookout for an email and then click on that email after tonight's call and then register for the Tuesday webinar. That's it. Now, if for some reason you have a problem, go to accessinsidergroup.com/info or reply to the email that you were sent that invited you, that you eventually clicked on to get here tonight. One way or the other, track us down if you have any problems or check your spam folder to make sure that the invitation didn't get stuck in there. But at the end of the day, make sure that you look for that email and you will receive it tonight. My last comment, be decisive and take action in the face of uncertainty. No matter what you're going to do, take action because opportunity is on the way. You've got to be the victor. You can't be the victim. That's not okay. And especially during unprecedented, uncertain times, you've got to fight to be the victor. If you don't do it for you, do it for your family. Now, I'm a market timer. Yeah, I'm an investor in real estate. I'm a private lender. I'm a fund manager. My sons are as well. And what I want you to know is that during the worst economic chaos that we've had before this, which was the 2007 through 2009 crash, we actually capitalized mightily. And it was at that time viewed as unprecedented too. So this doesn't scare me. It's only a matter of figuring out what's coming next. You can capitalize this time too, but you got to figure out how to make the economy your economy. You got to start doing. You got to invest in yourself. You got to build relationships. Don't allow this to pass you by. You've got to be a fewer better. Our mantra is that we do fewer bigger things with fewer better people through fewer deeper relationships. That's why I want to get to know you. I want to have deep relationships with a limited number of people so that we can capitalize on making the economy our economy and being major victors. Imagine if we capitalized on this uncertainty together. Well, until next Tuesday, let's just agree that you and I both want to maximize our income and our wealth. We can at least agree on that. We can at least agree that we want total financial freedom. I have it. My sons have it. I want you to have it. And to that end, if you're serious, not just curious, join us by doing those two things I ask you. And remember, just as Winston Churchill said in 1944, when the World War II was not looking good, never let a good crisis go to waste, and boy, did he take advantage of it. So I want to thank all of you for joining us tonight. And here we are at the end, but I'm hoping that this is actually the beginning, and it's really up to you to choose. I do hope you'll go to accessinsidergroup.com/EXP and tell me about yourself if you haven't. And in any event, you've got to sign up for next Tuesday's webinar. Same time, next Tuesday, July 21st. Until then, have a great week. All the best to you and your family, and stay healthy and safe. Take care.